All right, again, let's get started. Um, so thank you, everyone. Just to kind of a quick reminder, um, to start with, this webinar is being recorded, so and a link will be shared out to you guys, so you can always look at it again. We are not investment advisors. We are not trying to get you to buy something. We're not trying to, get access to your money. So please decide for yourself what you want to do. Obviously, we are a group talking about value investing and investing, so uh, less so about trading and other things. If anyone has a question, please raise a hand. What I will do is I will unmute you from here, and then you can ask your question. I know we might have some issues as this is the first time we're doing, but if you have an issue, just write in the chat. Looks like no one wants to turn their camera on, so I'm the only one that everyone can see and I can see as well. But next time it'd be nice if people can turn the cameras on. It's more interesting for everyone. Okay. So firstly, we've kind of looking to expand our group. So we've taken over a group in Singapore about value investing. And this is the reason we're doing another event tomorrow morning, which is kind of a repeat of this one, but it allows people from Asia to join at a convenient time. So just a quick thank you. I know a lot of you guys actually invested in our funding round, which is great. So we ended up raising more than $500,000 just before this crisis started, which is kind of a big blessing for us. Things would have been really tough if we were to raise money now. So we will continue, as our vision is to create a product which is, better than Yahoo Finance, better than Bloomberg, and at an affordable price. Can see a lot of people joining in. Yeah, good. So let's start with, given that we're using online tools, let's start with, taking advantage of this. So I'm going to launch polling, which you guys will see, and then just click buttons. I think this is, I also wanted to kind of share with you the features of Zoom, which is one of the stocks we'll be discussing today. So it gives you a sense of, what a phenomenal product these guys have built. All right, 5 more seconds and then I'm going to close the polling. Okay. Hi,
Rizwa.
Hey, Chris. Hey. Can you guys see the results? So quite interesting that we've kind of got a 30%, a third in terms of people with experience. Very fascinating that people are buying undervalued stocks, which is very interesting as value investors. Quite curious what is the other thing people are doing. So you can add in chat, if you want to explain or raise your hand. Yeah. Okay, let's move on. Let me just shut this poll. Okay. So I got some feedback from one of you today on a chat saying, I come across as very kind of always being, don't buy in this market. And so, I mean, not that I'm saying that we should be buying at this point, but I just wanted to start on a positive note instead of focusing on the negatives, which obviously everyone's seen. So let's start with, what everyone's been looking at. So this is the Zoom stock. Now, what I've done is I have added NASDAQ, which is here, right? So NASDAQ has gone down about 9% from when the time that Zoom IPO'd, while the Zoom stock has gone about 58%, which is, kind of phenomenal. We've been using Zoom in our team for, I think, more than a year now. So just to give you an idea, with City Falcon, we are a team of 35 people. We're located in several different countries, and so we use a lot of online tools, and Zoom is one of them. So yeah, so the stock has done phenomenally well, but the question is it worth buying? Because it's gone up quite a bit. So again, you need to do your detailed research, but I've just got some quick things to show you guys the way that I would look at something very quickly to kind of see if this is something interesting for me to research more. Um, so you look at the market capitalization, which is 37 billion. I haven't checked the debt in the books, but I'm guessing not much because it's a growth stock. So usually you wouldn't get a lot of debt. Now 37 billion, if you compare to some of the other things, is more expensive than, let's say, for example, Twitter, or some of the other major companies. So it is valued highly now at this stage. The other thing I would typically look at is what are in terms of earnings. So this is kind of the EPS trend that I got from Yahoo Finance. Now these numbers may not have been updated for what has happened now. So July 2020, these are yearly numbers. So for a stock that's trading at, what's the price, 135, their EPS for this year is 44 cents, right? So it is kind of a crazy price earnings multiple, but this is because it's a high growth stock, right? So if the company now, for instance, we had to buy a license to conduct this webinar, and so we are going to pay them. And the cost goes up significantly as I add more people on this webinar, kind of hosting, or more people in the audience. So they are making money. So these numbers could be high, but it is trading at quite a high multiple. And again, this is because we've come through an environment where we've had high liquidity, a lot of money being printed. So this has been built into the stock, and it's continued that rally. One thing to note, though, is if you look at the trend, just after the IPO, it actually went down quite a bit, up to 20-25% down, which is typically what you would see in a tech IPO. And then the recovery has happened. So these are numbers. I would pause here because I want to make this more interactive rather than me speaking. So anyone has any thoughts or comments, just raise your hand. I'll unmute you and then you can talk.
Yeah, a question around Zoom. Doesn't it have a lot of competitors? GoToMeeting, for example, and others. So why Zoom and others?
Yeah, it's a very good question, and actually it was one of my concerns as well. So if you look at the history of Zoom, right? So Zoom was founded by one of the team members of WebEx, and WebEx was bought by Cisco, which is one of the widely used softwares as well. And we've had, as you said, GoToMeeting. We've had a lot of other services. We had Skype, for example, where I used to work before, which was bought for about $8 billion by Microsoft. And this is $37 billion. So you're absolutely right. There are issues. However, what I would say is that what these guys have done is build a phenomenal product, which is very easy to kind of manage. Getting this webinar was, not too complicated for us. There are, some things they can fix, but significantly better than the experience personally that I've had with WebEx or GoToMeeting or others. But anyone else has any feedback? Anyone else has used other products?
I just had a question, which was, why are people so excited about Zoom specifically, instead of some of the other kind of stocks that are, going to do well from more people working from home, like Slack, for example, which seems to be a lot cheaper than Zoom. Why is it that everyone's so excited about Zoom specifically?
Yeah. And Charlie, if I remember, you have a position in Slack now.
Yeah.
Yeah. Okay. So we'll come to Slack after this. And again, guys, we had discussed Zoom and Slack, I think, at one of the themes for 2020 about remote working. I think, Charlie, you will see that, for example, one amazing thing about Zoom is that, just want to show you, Zoom is profitable, right? Slack is not even profitable at this stage. Also, I was just looking at the numbers. So before Zoom went for an IPO, they had raised something like $140 million. Slack, on the other hand, has raised more than $1.4 billion. So I think there are a few differences between the two companies. Having said that, I do believe that Slack is a little bit more of a complicated product. Not that making Zoom is easy with allowing 1,000 people to be doing video calling, which is absolutely phenomenal. But I think it's just that there are not a lot of things to buy in the market, and people have seen. I think what we also saw was, for example, WHO, when they were doing their conferences, they've been using Zoom. A lot of the government organizations have been using Zoom just because it's just very easy. Go to the website and set things up. Other people, thoughts?
Yeah. So, hi. It's one thing about the competition. Like, we use Life Size Cloud. We use Link from Microsoft, which is Skype for Business, and other stuff. And so we use Zoom as well. And even though there are other competitors, the market is quite fresh and big. And the companies will find some sort of product that they will like or buy or something. So I wouldn't be deterred by that there is a lot of other competition. I see it as a healthy market space with a lot of other exciting products out there.
Yeah, that's a good point. Yeah. Anyone else?
It's Catalin here. Hi there. Just a thought. Zoom is focused on the business market, isn't it? So people working from home and having conferences. And I mean, just from personal experience, there might be there are some companies out there. I don't know if you know of any that are quoted, but that focus on friends having conferences, or sort of another branch of that same market where there might be opportunities that haven't been discovered yet.
Yeah, I think that's a good point. I mean, there are a lot of consumer tools, right? So FaceTime, obviously people use Skype, WhatsApp. Having said that, people could use Zoom if they want to. There is a free subscription. But you're right. I mean, I think it is primarily focused on this market. But I'll let anyone else, add thoughts onto this. Zuli, you wanted to say something?
Hi, Zoet. Yes, we use Team, Microsoft product, and it seemed to be working okay for us, but that is within the organization. Perhaps this might be better outside the organization.
Yeah, that's a good point. I mean, Microsoft Teams also you can use outside. I mean, I had a call today with that. But I am not generally, so impressed with Teams because there are things that usually go wrong. But yeah, good point. Other people, Alexander, you wanted to say something?
Yeah, Zoom is an interesting one because I think it's fallen into that narrative of the future of work. A lot of people are basically seeing it as, especially one of the darlings of Silicon Valley. But the issue right now is that it's incredibly overvalued. I mean, you just mentioned the PE multiple, but one of the reasons as to why it's trading at such a significant premium is because it's one of the very few SaaS companies that is extremely profitable and good gross margins, etc., in comparison to its peers. But I think just because as long as they continue to demonstrate that they have, they're going to hit their revenue targets, investors are constantly bullish on them. I think they just recently announced their earnings, etc., and they beat their estimates. But I still am on the cautious aspect, just simply because one revenue slip or earnings slight miss can significantly impact the current price. Right now, I think it's around 1,500 PE multiple. It's incredibly overvalued, I think, in my opinion.
Agreed. And I think this is a stock I would say to watch, and then if it comes down, there are opportunities. Also, as you mentioned, with SaaS businesses, the amazing thing is that once you become profitable, your gross margins are pretty high. So every additional dollar of revenue could most of it could go to your profits, which is great, without any incremental cost. So your profits can jump, EPS can jump pretty quickly in these kind of businesses if they are able to scale. All right, guys, let's move on to the next one. So Charlie's favorite stock, which is Slack. Now, interestingly with Slack is that it has fallen quite a bit after the IPO. And I think we had discussed this back in Jan. The main reason was that because Microsoft claimed that they had more daily active users than Slack. So in Microsoft Teams. But I've used Teams, and I think, as I mentioned, it is a really poor product. And I used to work for Microsoft, because they bought Skype. So the stock had fallen quite a bit after the IPO, like more than almost 50% down, which was and I've been tracking this quite a while, but it's just that I thought everything in the market is overvalued. So Nasdaq has fallen 15% from the time it listed, and the stock is still down 32%. And I think this is mainly because I'm generally a big fan of management. For people who remember this discussion, I'd mentioned that. So I think we pay something like £250 a month to Slack for our team. And the thing is, if there is one team member for whom we've taken a license, but they don't use it in a month, they don't charge us. So, ethically a great company in the way they run business. But the stock hasn't gone up quite a bit. And this could be an opportunity. So if you look at the numbers, 14 billion market cap, compared to 37 billion of Zoom. Now Slack does much more. I don't think they have video calling yet, but they have normal calling. And it may be possible for them to add the functionalities that Zoom has, given the situation and given where we are with more of remote working and everything. So in that sense, it looks cheaper in terms of the market cap valuation. The downside is that they are not expected to be profitable anytime soon. Now, these are obviously older numbers. If things improve for them, they could be profitable. But I don't think in this tech world, profit is that important. I think if they can show revenue growth, significant revenue growth, there is potential for the stock to go up. So I'll pause at this stage for people to share their thoughts on Slack. Hey, Prior, yeah, go on.
Yeah, hi, I'm just curious. In general, tech stocks like this, obviously most of the value is in the future. It really depends how these companies grow and whether they hit their forecasts now and in the future. How do you typically actually go about valuing or thinking about the growth, trying to predict it and so on, or do you do that?
So it's extremely difficult, as you'd imagine, for a company that's not profitable yet. Personally, I look at the PEG ratio, so price earnings to growth. So if a company, let's say, expected to, grow 30% a year, then I don't mind paying a price earnings multiple of 30, which kind of gives me a PEG of 1.
But I guess that means that you are still looking at the 1-year growth, whereas for Slack, I guess the biggest opportunity is in, let's say, 10-year growth, for instance.
Yeah, agreed. So I think you could probably go top down. So guys, I'm going to mute people who are not talking, so it's less noisy. Yeah. So you could go top down, and you could potentially look at what a management consultant would do, saying, hey, how big is this market of remote working? And let's say they could have this much share in the market. It's slightly going away from value investing and even growth investing, but I absolutely agree. It's a much longer term play. How would you do it? Do you have thoughts on this?
No, I would also go to the management consulting style. Probably was just curious if there was some other way that people are also looking at these things?
No. I think, yeah, with these stocks, you have to kind of, everyone kind of believes that it does well, which is why the stock market maintains it, even though it's still not profitable. Other thoughts? Maybe Charlie, you have a thought, you own the stock?
Yeah, I mean, I've just used Slack myself for about the last 5 years at 2 different companies, and just absolutely loved it and felt that it's really helped. Especially like I work for some 2 tech startups, and so working with remote teams from around the world, it's really helped. I found it's been really sticky as well, because it's got years and years of knowledge and documentation that's like sent through Slack. And just a small point, like you can do video calls through it as well as it's got some really easy Zoom and also Google Hangout add-ons that you can integrate. So you can just, in one command, you can launch a Zoom call straight through Slack if you wanted. It's one that I really love the product, and yeah, it's felt like a good buy in recent times.
Thanks, Charlie. Charlie, maybe it's a time for you to do a detailed presentation at some point. Share more thoughts with us. Cool, let's move on, guys. So Netflix, obviously a lot of people staying at home, using bandwidth for kind of content instead of working, which is, not great. I mean, I myself, for example, I've never bought anything beyond, having my Netflix or Amazon Prime. I've started buying kind of series that are not available that I want to watch, which I never thought I would do. So I think in general, the market is saying, there is a potential for the company to go higher. So if you look at some of the numbers now, NASDAQ has fallen 18% in the last, I think this is a 3-month period that I took. And, Netflix is up 5%. It's been quite volatile. I've been tracking it every day because I'm interested in the stock. To be honest, not to buy, but to actually short at some point. And I'll tell you why I think that. So one is that it is valued quite highly at $152 billion at this stage. And if you look at their earnings, so I think these are the earnings, so $6 and $8. Now, it's trading at whatever 40, 50 times earnings, which I would, as a growth company, I would pay that kind of money if I can see the revenues going by 40, 50%. So at this stage, I mean, I need to do a little bit more research, but at this stage, there is a lot more competition coming in. Netflix content quality, generally based on what we've read, seems to be going down. And people are kind of, looking at other options. So I think that issue remains. One thing, though, I think that Netflix and something that makes me nervous if I were to short this stock is that what currently they allow users to share their passwords, which is kind of reducing the revenue opportunity. But imagine if they were to say, you pay whatever the $10 subscription is only for one user. And now, even though the number of viewers may go down, the number of subscribers may actually go up significantly. So yeah, so any thoughts on Netflix? Hey, Kathleen, go on.
Not sure if you looked into their debt level. I think it's extreme. The way I look at it is I check with how many years of earnings could they pay off their debt. And last time I looked at it, I think it was the 2018 annual report. It was around 8 or 9 years, which is extremely high. And the other concern is that as the competitors are also launching their streaming services, they are removing very popular content pieces from Netflix, like Friends and Avengers and all those attractive pieces. And I don't think they have too much original content yet, though they are definitely working on that, but I see that as a concern.
Yeah, very valid points. And I think we had discussed Netflix, I think a couple of years back. So they have debt in the books. I think on the other side, in the balance sheet, they also have original content, which they have kind of capitalized, saying there'll be future revenue. So absolutely right. I think we should look at the balance sheet as well, on which side it tilts. Agreed. Okay. Other thoughts from anyone? All right, cool. Okay, let's move on. So guys, so popular themes, and again, you guys can add, what we're seeing is obviously remote working, collaboration tools that we talked about. And, if you look at the tools, not only in the UK, US, there is Atlassian, an Australian company. So there are a lot of companies in this space, but those have gone up quite significantly. So that's an issue. Entertainment, kind of, people talk about the cocoon effect, which is, apart from more babies, you spend, more time consuming content, be it music, video, games. You have services like Ocado, which are online only supermarket. So they have done well. Obviously pharma, and then, essential services. So we're seeing a lot of these companies going up. So just kind of the way I look at it, this is the markets were inflated, right? Before this issue came about. And these companies may have rallied as well along with the market, and now they're going even higher. So while there is an opportunity, while these companies might do well, be it in the short term now for services like Ocado, to in the long term as we change our behavior significantly in how we kind of work or move about on a daily basis, but it's still quite expensive. Any thoughts, any themes from anyone else that we should be looking at?
It's Catalin here again.
Yeah.
Just a thought, maybe, I don't know any of the technology companies that underpin some of these companies in these themes, but that could be another area to look at, maybe as an opportunity to find stocks that are not yet overvalued. Maybe just an area to look at.
Yeah, sure. Agreed. Yeah. Anyone else? So by the way, guys, I'm getting comments, which, and I'm trying to figure out Zoom as well, which only the panelists can see. But I think if you're sharing a comment, please, in the drop down, select panelist and attendees, so everyone can see that, instead of just the panelist. So Gurdev is saying about utility companies. Yeah, sure. People staying at home, spending more. So you could be looking at that. Yeah, go on. Anyone else, thoughts?
So one thing, say pharma, but also healthcare. The whole healthcare sector is sort of. I don't think it's really increasing at the moment, but it has seen not too much of falls.
Yeah, agreed. Okay, so I should have expanded that to healthcare. I agree, instead of just pharma.
Pharma, yeah.
Yeah.
The other thing somebody said utilities, but what's also kind of going on is the Russian companies. The non-renewable energy sector has gone down significantly. However, in renewable energy sector hasn't had that much hit. I mean, considering the oil prices that fell and all of that has had a huge impact on renewable energy. Not too much impact on renewable energy, but quite a big impact on petrochemicals and stuff like that.
Yeah, fair points. I don't understand these markets well enough. So, but yeah, good points. Okay. Anyone else? All right, let's move on then.
Yeah. What's going on?
Sorry, I'm just going to mute people so that, yeah, it's not noisy. Okay. So let's move on. Oops.
Is
Sorry.
it recording this or something?
Someone needs to go on mute. Okay. So I'm trying to find a button where I can mute everyone. Sorry, Caroline, you wanted to say something? All right, let's move on. So guys, S&P 5. Okay, there's an echo. Sorry. Can everyone please go on mute? Okay. So S&P 500, obviously, and that's what I kind of have chosen instead of Dow Jones and other things. So, I mean, as everyone knows, it's fallen quite a bit. It's recovered, yesterday, and it's recovering now. So everyone who's bought at the low will be making some money for now. So you see that it was, more than, I think it was 3,500, and it gone down to 2,300, and it looks like a massive, massive decline, right? However, if you look at, and sorry, let's look at FTSE as well. So from 7,500 to 5,500. Now everyone has seen this, so I'm not going to spend too much time on it, but let's take a slightly longer term chart, right? So this is from 1999. And so if you look at FTSE, if you see the big declines that happened, the bear run until 2003 and 2009, and then now, we are here. Obviously, with FTSE, there are a couple of other plays that had an impact. One is Brexit, obviously, which has affected, obviously a lot of sentiment and other things. Also, the value of pound. So, as the pound depreciates against the dollar, the FTSE usually goes up because a lot of the UK companies have revenue outside of the UK. So that kind of helps. So I mean, FTSE has it looks like it's close, but it's still 1,500 points away from where it was in 2009, in the low. But let's look at S&P 500, right? I think which is a good benchmark to look at. So where we are now is not even below 2017, right? So we've hardly had, we talk about this big crash, but it's hardly anything compared to the run we've seen over a period of time. And if you think about, post-Brexit, post-Donald Trump, continuous quantitative easing that the banks have done, printing money, inflating assets, pretty much every asset. So this decline is actually not a lot if you think about it. So I'll pause at this point if anyone has any thoughts on this. Do people think this is a big enough decline to start buying, or do you think we can go down further from these levels?
I would say, don't buy in. The strategy I'm doing is not buying in bulk, but buying regularly in smaller amounts, sort of spread it over time.
Yeah, so you're averaging it out.
Averaging it out, one, because I don't have enough capital to just go and buy. It's too risky at the moment to have, if you want liquidity over short term.
Makes sense. Yeah. Anyone else? Okay, let's continue then. So this is a graph that, I've shared before, and sorry if, it becomes painful, I reshare it. So, this is kind of historically what you would see, and you would see this cycle going on every time. So what you need to decide for yourself is, where are we in this cycle, right? So we know that the top is gone, right? There was a top of this market. Now the question is, are we over here wherein we've seen a decline and we've seen a little bit of pullback, which is what is happening last couple of days. It could go up further, or we are already here, right? Which means that we'll come up again from here. So this is completely your decision. My personal feeling, and this is the reason I'm not buying at this point, is we are here. Okay, this is my personal feeling, that we are in the bull traps phase, and I'll explain why I think personally that this is the case. It's just because we're in a lot of shit, to be honest. Like a lot of things that could go wrong have gone wrong. but we'll talk. So any thoughts here from people? Where do we think we are currently in this cycle?
Hey, Rizbaz, Priyesh.
Hey, Priyesh, go on.
Yeah, you know what? I think I agree with you. I've got this fear that, you know, we're going to have a few months of this and then everyone kind of goes back to work slowly, but it's going to be such a phased manner that I think the markets will continue to suffer. And then we might have another round of the virus coming around if we start entering into, like, I guess, winter and then a change of season. So I'm just, yeah, I'm not sure how it's all going to play out, but I don't think we're out of the clear yet. So I probably agree with what you're thinking.
Thanks, Priyesh. Okay, anyone else?
Hi, this is Shisha here. I believe this recent uprun of market is purely based on some extreme measures taken by US, like $2 trillion based off liquidity they're going to push in the market, as well as quite a lot of other measures and the reduction in interest rates. But what I believe is market actually hasn't seen yet the real impact of this coronavirus apart from lockdowns of cities and countries. Maybe in next quarter, we would actually see real earning downgrades coming from quite a lot of companies, which may lead a couple of countries into recession. And that's where I believe quite a lot of downfall in the market is going to come. So I do agree with you. We are kind of at the return to normal type phase at the moment, which appears, but there's quite a lot of downfall still expected. So I'm kind of holding on to some of my cash to be used later on if I believe market would fall quite significantly. And if not, if it starts just keep going up, still, there would be opportunity to buy quite a lot of undervalued stocks to give further decent return.
Makes sense. Yeah, agree.
Yeah, I agree. Hi, it's Anna here. Yeah, I think there are still quite a few talks of recession, and even with the COVID, we still haven't had the worst phase, which is apparently supposed to happen in May, according to what happened in China and Italy. So in the UK and the US, I think there's still too much uncertainty. So I agree with you as well that we're still in this return to normal phase that you're showing here.
Thanks. Anyone else who believes maybe it's different?
It's so high. So yeah, I think we are in that bull trap return to normal. Things will go low, but it's not probably due to supply, but it'll be due to demand in terms of people, capping their spending. Now, I work for a company who does a lot of manufacturing in China. Whatever happened in China and everything, they have really been able to manage and contain, well, two things: the operations in our company and the supply chains in China and Far East. They have actually been able to cope very well in not impacting major supply lines. So all the chips we manufacture, we have surplus stock, and we have enough supply lines now to actually meet demand, even if the demand maybe increases. So I wouldn't write it off as things will come to a grinding halt. In any sector, it'll be a lack of demand, which I believe might be mitigated by the amount government will spend not on corporates but also on people, which I'm kind of almost hoping that all the quantities easing and all that will happen, will not just go to big corporates that happened during the bank, the Lehman Brothers crash and all that. It will this time around. It'll probably go to people as well.
Yeah, that's a good point. Yeah. Sorry, go on. I didn't want to interrupt. Okay, Kaushik, you wanted to say something?
I mean, I'm not Kaushik, so I just, as there's no sound, I just speak out.
Go on.
I just want to share maybe some of my recent thought about, this recession and COVID-19. So I think the despair we are in now was really to underestimate what the impact of COVID-19 will be on our countries. And that's where we end up because no politician took it seriously. And now I think we are finally at the stage where they take it seriously, and because they didn't at the right time took the right measure, like buying masks for everyone, we are in a quarantine phase. But if now we try hard to control it, we already see, I mean, a stabilization of cases in Italy, in France, and I think now even in Spain. So I actually think we might, recover not that long from then and have a path similar to China, and they solve it in 2 months. So I think potentially maybe there's a crisis, but COVID-19 might not be the main reason of the crisis. So something I thought. So I'm in between. I think maybe there's hope, But yeah, so that's my thought around that.
Sure, thanks a lot. Okay.
Zuli here. I think we haven't reached to the bottom of it yet, and I reckon that this tsunami is going to it will have a massive impact that I don't think that anybody can estimate or can underestimate, more likely. We are already seeing the impact of unemployment, rent arrears, to say a few, and then we're looking at impact of raw materials and the supply chain. I personally estimate that it won't be before September, October that we'll realize, and all these initiatives that has been announced, how it is going to filter down the chain. I think that's going to be a real big challenge. So I'd agree with you, we're not at the bottom. I think we are more like in the bull trap.
Thanks, Zuli. Okay. Anyone else?
Hello, Sandeep here.
Yeah, go on, Sandeep.
Yeah, basically I look at the technicals, so I was looking at when we had similar kind of falls, and I went to the last ones, which was in 2007, and then I went to 2000 when you had the dot-com crash, and all of these crashes, there was a very gradual sort of downward trend. So the only one which is comparable to this one, because this has happened in about 3-4 weeks, is 1987. So 1987, you had a very similar sort of very short and sharp fall, but recovery took about 1 year after that. So basically, I would say you need to wait. I don't know. It's not going to recover that fast. That's all.
Yeah. Yes. Can you hear me?
Yeah, go on.
Yes, I just wanted to make a technical point. Uncertainty by itself, translate into standard deviation. So just and taking into account the uncertainty in a mathematical way, create a downward pressure on stocks. And therefore, just acknowledging the uncertainty means that you have to acknowledge that there will be a further down. So that's all I wanted to say.
That's a fair point. Yeah, thanks. Okay. I know Kaushik wanted to say something. You want to try, Kaushik?
Hi, can you hear me?
Yeah, we can hear you now. Go on.
Yeah, I think the only point worth adding is incrementally, unlike 2008 and previous crashes, the liquidity taps have already been opened. So I think the correct question would really be asking is, if you're going to deploy capital in a market like this, what kind of capital duration do you have? I think if you sit down and you weight your capital by the duration, you say, I have 10 grand, which out of 2 grand, I know I can lock up for 30 years, 2 grand I can lock up for 10, and 6 grand I need right now, then that kind of answers your question, because always asking the question of where the bottom is always a fool's game. You're never going to catch the bottom. So the way I would look at it is, how much capital can you lock up and for what duration? I also feel that why this recovery will be different is because unlike previous times, the liquidity tap's already opened. So the slide is good news. You'll see a rally, and the slide is turn in that news, you'll see a crash, because a third point out here is market dynamics are different. Right now you have lots of algos trading. You have lots of quant funds, more and more quant funds coming up. And while this meetup is called value investing, all those guys are only participating on price action. So the ferociousness of the moves will be, in my opinion, will be much more as well. So I think if you sit down and kind of answer, those are the 3 questions I'm asking myself.
Thanks, Kaushik. Makes sense. All right, let's move on, guys. So in terms of recovery, everyone talks about, kind of the V-shaped recovery. And thanks, Sandeep. I think you kind of mentioned there are different types of recoveries that can happen, right? So I couldn't find many graphics on this, but this is kind of looking at US GDP and how that came back. And you saw that we had a kind of, very quick recovery, even the stocks took some time to recover, but the GDP recovered fast. Obviously, the stimulus came in, and, Kaushik made this point about, which I'm going to talk about later as well, is the tap had been open with the liquidity and quantitative easing, even in the boom time, which is very different from previous times. But anyway, so this is a V-shaped recovery, but then you also have an L-shaped recovery, right? Wherein kind of it goes sideways for maybe it's 1 year, 2 years, 3 years. And the challenge with this is that when this happens, when you don't see growth, companies might struggle. And one thing that I will say on another slide is, we talk about long-term investing, but be aware that a stock price can go to zero. Having invested for the last 20 years in a lot of different markets, I have seen companies that have gone bankrupt in my personal portfolio. So you have to keep considering that. And then after L shape, you also have the U shape, and you also have the W shape. Sorry, I couldn't find pictures for these. But if you Google, you will see a lot of different historical, and Sandeep made this point, right? I mean, we should look at history and what we can learn from there. So there are a lot of different cases in terms of what recoveries we could have. So just a quick reminder for people who are using chat, please make sure you select all panelists and all attendees. Otherwise, everyone cannot see your comments. So those who have done only panelists, you can reshare for the benefit of everyone. Yeah. So one of the things obviously that everyone looks at is kind of price earnings ratio, right? And so I took a really long-term period. Again, I've taken from this website. So take it with a pinch of salt. It's not as easy to calculate. But what is interesting is in 2000 over here, you see the price earnings going up, and the same with, the 2008, 2009. Now over here, we are right now, as per this website, at about 18 times price. So can any thoughts on why this is the case? Why is it so low? Anything you see in the chart which is misleading? And I have an answer on the next slide. So Dimitris, go on.
Yeah, maybe it's not that low. And when you see this spike, it's probably because the EPS of S&P went down because you had the crisis. So you had lower earnings, the EPS went down. So that's why you had that EPS. So I wouldn't say that 18 is extreme, but it's neither, see, probably it's above average. If we normalized it, that would be above average, I think.
Yeah, okay.
Even the PE needs to be compared against interest rates. So the lower the interest rate, the more, I mean, the lower, I mean, actually the higher the PE ratio.
Yes, there's more liquidity, so people are ready to pay, yeah, fair enough. Okay. Sorry, you wanted to say something?
Yeah. You mentioned the PEG. If earnings don't grow anymore, then the PE ratio is not justified when it's very high anymore. So those companies which were valued based on PEG will suffer at the time of lower earnings growth.
Absolutely. So let's move on to the next slide. So what could happen now is, and people can correct me if they disagree, is now we're going to see a drop in earnings, and no one knows to kind of what extent. And if that happens, basically what will happen is the price earnings ratio will actually shoot up. So maybe when you start looking at earnings coming in, people will realize, oh my God, S&P 500 is trading at 35 times earnings, 50 times earnings, 70 times earnings because of the big drop. And this is where you could see another kind of downside coming in. Thoughts from anyone on this?
Is that calculated at the year level or at the quarter level? Because if at the year level, it will be much less different. I mean, they will be less different than just a quarter, because I think the downside will only just for one quarter, not the whole year, but maybe not. But that the biggest one is for one quarter.
But wouldn't you then see that I think what might happen is the analysts will have to change their Excel sheets and models where that 1 quarter change will reflect. Again, I mean, it depends on your assumption saying, okay, we find a vaccine, everything is back to normal. And then if people believe we go back to the inflated prices, because we have all this money that has been pushed, then that's one scenario. But if you think it's going to be a longer term impact, then maybe we might have an issue even with quarterly numbers going down. Sorry, go on, Dimitris. Kathleen, you have any thoughts, or you've raised your hands?
Yeah. I think in this case, it might make more sense to look at the so-called cyclically adjusted PE ratio, or Shiller PE, which looks at earnings as a longer period, and then you wouldn't have that spike in the end, I think.
Fair enough. Okay. I mean, if you have any link, if we can share in the group for everyone, I think that'd be useful.
Sure.
I would love to see that.
Let me look that up.
Thanks. Okay. Dimitrios, you had something to say? Okay. So let's move on. Right. So the key thing is, we're talking about earning estimates and other things going forward. So because I run my own business with a team of 35 people, and I'm on multiple chats with people, founders, CEOs of companies, everyone is panicking right now. Okay, people are worried about paying the salary, people are worried about no revenue coming in, the massive disruptions we are seeing in the market, and so a lot of businesses are going to fail. Even with all the schemes announced by the UK saying you cover £2,500 of salaries, Malta, where I'm based, says 800 euros worth of salaries of people printing money, but it's still going to be really difficult for a lot of businesses to survive. So just keep in mind again that companies could fail at this point. So let's go back to the basics, and we saw that 30% of the people in this group are less than 1 year investing. So I keep kind of going back to saying I need to go and have this margin of safety if I'm going to invest in this market, right? Because it's my hard-earned money and I don't want to be speculating my money. So and the challenge right now is really to find this kind of intrinsic value, right? It's really difficult at this stage because we don't know what the earnings would look like. We don't know what the impact, the short-term impact, the long-term impact. So there's not much you can do from a value investing perspective at this stage. So yeah, so the point is here, I'm active in a lot of forums on Facebook and other places. People are talking about markets are cheaper, but it's still not cheap. And I think this is an important thing to note. And this is the reason I'm not jumping in to buy anything. I have had, I have burnt my hands with, falling knives in other recessions. And at this stage, I wouldn't do that. So before we move on, any other thoughts or anything from anyone?
I think that there's some stock that really fall below what they're worth. And what I think is at the moment, we are not able to know who are the winner and who are the loser of this interruption. So I think there's a lot of opportunity. So yeah, the market is cheaper, but not cheaper. If we look in terms of individual stock, there are a lot of, I think, opportunities, way more than usual. So I think it's an opportunity, actually.
Okay, fair point. So some stocks you might find are cheaper, some themes. Yeah, okay. All right, let's go on. So this is a phrase that you usually don't like to say. Like, if anyone says this time is different, and it's typically used by people justifying why the bull run will continue. But I'm going to use this, and even though you shouldn't use it for this kind of scenario, because we are in a state where if you look at history, you might not always find comparable examples. So I looked at 99, 2000 and 08, 09, just because I've seen those recessions myself. But please share, anyone has thoughts about earlier recessions or anything else that they know from history. So the one issue is people are dying, right? We didn't have this scenario in the last two. So while the governments talk about stimulus, I think they have a responsibility towards, healthcare, towards other things. Enterprises are trying to help out, and I think that's the right thing to do. People making masks and respirators and all that. But it will affect, earnings, which I think is fine. I think if we help people to live, we can build the economy again. But this is something to consider when you're putting in your money. Second thing was, before even we got into this mess, there was a lot of quantitative easing. And you could talk about Donald Trump wanting to keep the markets high, or some governments wanting to appeal to the industrialists. I think it was pretty much happening all the world over. So stock markets were doing well. So this time, central banks don't have much room to maneuver at this stage. And the third thing is, we've seen this massive, influx of funds into passive funds, which we had not seen before, as people who may not understand markets just putting money in, and then obviously the fund managers have to invest. So these are three things, and probably there are more. I think, Kaushik mentioned about algo trading, which kind of exaggerates the move up and down. So if we go down, it could go significantly down before we recover. So there are a lot of things to consider. So just break it down. So I looked at kind of Fed fund rate for a longer term, and I think you could pretty much look at any country's interest rate. So if you look at previous recessions, right, which are these gray areas, you see that the interest rates were quite high before we went into recession. They were quite high, but this is where we are now, right? And this is kind of where central banks can't do much, and negative interest rates, but how negative are you going to go, and what is the impact of that on the economy? So this is kind of one issue. Second is just we continue to, I expected not to be printing a lot of money, but this seems to be the only solution right now, to print more and more money. Even though I've studied economics, I'm still not sure. And I keep thinking back about what the impact will be once we recover with so much money into the system, and whether, the governments and the Fed will be able to kind of remove that money out of the system. We saw, sorry, Zuli, you want to say something?
Yeah, can you send me one of those printing machines, please?
Yeah. Yeah, sure. It probably is worth less. Maybe we need to find something else to kind of print. Yeah. So printing money. Yeah. What I was saying was, I don't know if you guys noticed, but the last 2 weeks, we had pretty much every currency falling against the dollar because corporations and governments were buying dollars just because it's the currency to buy everything from oil, gold, and other things, which meant that, they had to push in more dollars into the system, which is kind of, so I don't know what the impact of this will be once we recover. Luckily, oil is low right now, which is one of the things people look in the inflation basket. But everything else, universal income, people getting paid, should push the prices up at some point. And then we talked about this. So there's an article, blog post we wrote about this a while back about how index funds could be causing an issue. So if anyone wants to read that. So anyway, I'll stop here to any thoughts on whether this time is different or is the same, or anything that you know from history that we could learn from. No thoughts? Okay, let's move on. Another thing to kind of note very quickly is when you look at gold and other commodities which are denominated in USD, yesterday and today, yesterday I think it went up, today it's slightly down. But just keep in mind that it's just not the value of the commodity, but also how dollar moves. So, dollar has given up a little bit of gains recently against some of the currencies, which has allowed gold to move up a little bit. So again, when you buy these commodities, you need to decide which currency you buy in because it could have an impact on your position. So yeah, one annoying thing is, obviously the pound falling significantly for all of us who have, money in pounds. And I still dream of the day when it was, 2:1. I was in Las Vegas, shopping for 2 continuous days in the US. But now it's 1.17. And even for my business, where most of our costs are in US dollars, it's a big issue. So this is again putting a lot of pressure on a lot of businesses. Any thoughts on the pound or gold that we've spoken about? Yeah, Anna, go on.
Can you hear me?
Yeah, I can hear you. Go on.
I would like to ask, because obviously there were talks about the pound currency changing, and we could see that because of Brexit, it went down significantly. I heard that it might take 10 years before pound gets back to the level before Brexit. What do you think, how long it might take before pound goes back to the level it was before Brexit?
I mean, my hope and dream is that it goes back up, so it's great for my business. But my brain says it's probably not going to do that. I'm not too optimistic on the UK economy post Brexit, but I could be wrong. But I'll let anyone else, if they have thoughts on this.
So you think it will never happen? That it will go back to where it was?
I doubt it, but I could be. I hope I'm wrong. I hope I'm wrong, seriously.
I hope so too. Thank you.
Yeah. Anyone else? Okay. So this is oil. One disclosure, I'm long oil. This is the only thing I've bought. And please make your own decision before deciding whether to buy or not. So oil, obviously, we had this issue with, OPEC falling off with Russia. And then, a lot of issues with, people not agreeing on the output of oil. Now, what this has resulted in is the price being lower than what it is to kind of what people need it to be profitable, right? In the US especially. So this means that, again, companies might go bankrupt, the supply may go down, or they might, discuss and resolve this issue. But basically oil price, if you kind of adjust for inflation, is one of the lowest levels over a period of time. Obviously, we remember, going to $19 or something, back then. But right now it's significantly low. So this is why I've taken a position. Again, I don't take big positions. I take small positions. If it falls more, I will add more. And again, I'm not buying any kind of company. I'm buying literally the commodity, which is again not easy for everyone to buy. But I use a little bit more sophisticated, investing and trading tools. Any thought on oil from anyone?
Why don't you buy companies? And for the when you buy commodities, do you recommend using some ETF, for example?
So I usually buy futures directly. The reason I don't buy companies is because if you buy companies, you're taking company risk, everything from management to the debt structure, all of those things. Like commodity is simple, much easier for me to kind of manage. And I personally feel it's a little bit lower risk for me. Other people? Anna, you had something to say?
I'll say something. Catalin here. The dividends of oil companies seem quite attractive right now, so that could be a reason that, well, it shouldn't be the only reason, but it could be a reason to have a look at them. I mean, the thing that makes me a bit concerned is just alternative energy sources and more focus on that. That could drive attention away from oil, but that could still be a few years out.
Yeah, and do you think these dividends are sustainable? I think that's the issue, right? Like as profitability goes down?
Over the long run, probably not. But if you can, maybe in the next 2 years, possibly.
Yeah, okay. Other thoughts?
Yes. Hello?
Go on.
Yes, I wanted to say the low oil price means less cost inflation, and this gives more room for maneuver for central banks of developed economies to lower interest rates. So this could be a positive in an indirect way.
Absolutely. And I think we spoke about this, the inflation being controlled by this. Yeah, especially in developing markets. Agree with you. Yeah, and I think people are, from what I read, countries are building reserves at these prices, which also should hopefully at some point push the price up. At least I hope for my position. Yeah. Other thoughts? Guys, I think people can unmute themselves, so I don't have to do it.
Yeah, I'm just curious. You mentioned at least the rationale that oil prices gone down a lot. Did you have some other thoughts on why it would go up? I mean, obviously, if the situation continues, it could also keep going down or stay at similar levels. So how did you think about that?
Yeah, as I said, if they come to some kind of resolution, because oil at these prices is not profitable for many countries or many companies. And also apart from companies, some economies depend on oil. So it could put a strain. And again, if something goes wrong, supply goes down, then again, and the demand remains same, the price should go up. If also the other thing is, if we recover from this virus and everything, then yes, we'll go back to normal if you believe that, and then the price could again go up. So for me, I saw when I took this position, there is limited downside. And even if there is downside, because I've taken small positions, I can buy a little bit more. So that's just my thinking.
Thanks.
All right, anyone else before we move on?
Yes, I think that there's more upside to it, Zuli here.
Yeah, go on.
Because this is artificially low, and mainly because of the two countries fighting, and it's not the correct level. And as you said, it costs more to get the oil out.
Yeah, thanks, Zuli. Okay, let's move on. Do many people know VIX? So this is the Volatility Index. With my portfolio, 80% is kind of long-term, and then 20%, I just play a little bit here and there. And Volatility Index has been one of the things that I've been playing in the last few weeks. Touch wood, until now, it's been okay. So for people who don't know, this is also called the kind of the fear index. So as when the recession happened back in 2008, it went up as high as $80. 80 points, right? And other than that, it's been stable between kind of 10 and 30 over a period of time. And we saw this. So this shows that it went to this, but because I track on a daily basis, it actually crossed 80. Okay, and then it came down after that. So if the S&P 500 drops more from here, basically this will go up significantly. So I kind of trade into this, but if things kind of, if the jump, if, you know, I mean, S&P 500 jumps, you know, went up and down 10%, this shoots up. But if it goes up and down 2%, it may not go up as much. So if you're interested, just track it, just see if you're comfortable. It's again, not easy for everyone to take positions in. And also interestingly, I think a lot of countries have it. So you don't have to necessarily do it on S&P 500. You could be doing it on other indices. Very quickly, if someone wants to read what it is, or you can search on Investopedia. It's kind of a tricky one to explain. For anyone who is good at any mathematicians, you could work it out, but for most of us, it's going to be tricky. But generally what it does is it looks at out of money call and put options on S&P 500 to come up with this kind of fear gauge or fear index. Any thoughts from anyone on WIX? Anyone who's used WIX before to maybe hedge their portfolios? Go on, anyone wants to speak?
I don't use VIX, but I have bought some out of the money put options in some companies that I feel that they are very overvalued. And what has shocked me is that because of this volatility, the price of the options have gone like 3 times up. And I have a dilemma because my initial thinking was, okay, I'll take 10 times my money if we have like a recession and the stock prices of those companies go 50% down. And the stocks have not gone that far. But now, because of the volatility, I mean, I can cash in, and I'm in a dilemma because I don't want to cash in now. So that's a thought that it's linked with VIX.
Absolutely, it's a good problem to have, Dimitris. Yeah.
Yes, exactly.
Yeah. Anyone else? All right, let's move on. So what is my personal strategy? And I would love to know from other people. So one is, you know, I want to wait for certainty. If there's a vaccine that comes out, or, you know, if we kind of isolate the cases and we become this kind of desocialization continues, I'll do that. I am shorting weak companies. So for people who were there in previous, before going into this, I had short positions before going into, and I made some decent money. So like Boeing, for example, I had short at 350, I sold at 114, just because there were a lot of things going wrong. And as you heard from Dimitrios, that he's taken out of money put options. I might do the same. You know, I might look for companies that have too much debt on their books. So shorting is an option. If I'm buying, I'm looking at companies with strong balance sheets. So I'm looking at, okay, how much cash do they have in their books? Can they survive, you know, this downturn? Because otherwise, even if the price earnings ratio is really low, but the debt levels are high, then companies might struggle. Number 4, instead of looking at companies, I'm looking at more commodities, indices, WIX, those kind of things. So I don't want to take company risk at this level, especially if I'm buying. And I am hedging my positions if I'm doing anything. Any thoughts from people? Any other strategies, or anyone disagrees with any of these strategies?
Any thoughts on airlines? I'm just curious. Obviously, they've been hit a lot recently. I'm thinking there might be some chance of course, government stepping in and making sure that we still have airlines in the future. Any thoughts on that industry?
So I think with airlines, it's quite interesting. So one, obviously there's uncertainty. So one thing, guys, from my learning was that, you know, we're okay till now, but if any company goes bankrupt or any industry suffers, like Lehman Brothers or Bear Stearns, then everything will come tumbling down. And my worry is that because the government has to focus on healthcare, saving people, they will have to let some companies go bust. And I think airlines is like, even though some of these are kind of almost like nationalized, there could be an issue. Also, if the government step in, it will be dependent on what conditions. So for example, the Boeing CEO said that even if they get support from the government, they wouldn't want any equity support. They would want debt. So again, those things will affect the price. So I wouldn't personally touch any airlines or any of those companies for now. Anyone else? What do you guys think?
Yeah. Hello?
Yeah, go on.
Yes. When you say strong balance sheet, I think this is subject to reassessment of the assets because assets could look inflated in the current climate.
I mainly mean cash.
Yeah,
like
okay.
literally liquid cash.
That's fine.
Yeah, so something like Apple, for example, they can live for the next 5 years without, worrying about anything. Yeah, but I agree with you. I think all assets are pretty much inflated. So you have that issue. All right, let's move on. The other thing I look for, and I've made some money in the past, is you could look for companies with enterprise value less than 0. So as the panic sets in, you might find some companies where the net cash in the books is greater than market cap. And you would be surprised how this can happen because of margin calls and other things. So, I mean, if you've used any stock screeners, whichever you prefer, try and set some alerts on some of the strategies that might work for you. Because these might happen. Now, one thing to be aware about when you're doing strategies is about there might be some industry specific things that you should be aware of. So for example, healthcare, might be burning a lot of cash. So that's why they might have a lot more cash. Financial services might have to keep it for, their obligations, their liability support, blah, blah, blah. So just be careful. But this is what I'm trying to track. And just a bit of a plug for our product. One of the things I do is I'm a news junkie. So I'm reading all the time. So I have kind of created this coronavirus value tracking sheet with all the things I'm tracking. So this was in the invite. So if you want to track it, it's free registration. But I just love to read, get views from other people. And that helps me kind of make my strategy. So I'll close with kind of saying that, it's like, going to war, and you just don't jump in, right? You wait for the exact right moment when you want to get in. And this is what personally I would be doing. So that's it from me. Any questions, any thoughts before I hand it over to Chris for the next session? Okay. So I know that we're deep into this. Are people okay to start immediately with Chris, or you want a 2 minutes break to stretch your legs? Can you just put it in chat? What do you guys think? Okay, to continue. Okay, Chris, I'm going to hand this over to you. Can you try screen sharing?
Thank you, Roosevelt. Very interesting. So hi everyone. Basically, I've put together an insight into some companies that I feel would be very good to invest in. So just a bit about my background. I became interested in real estate investing around 2010, 2011. I was studying in Ireland, and I found it very interesting to see that property, particularly commercial property, had decreased in value by up to 70% at the bottom of the market. And I started to read up about companies such as Blackstone, Lone Star Funds, etc., that had the capability of swooping in when the time was right and purchasing these high quality assets for 60, 70% discount. And that's basically what I do in my career now. I did my master's degree in real estate investment and finance. Spent 2 years in a consulting firm, advising on investment and development projects. And more recently, I hold a position as investment analyst at Social Impact REIT, which is owned and operated by Blackstone. We have about 1.2 billion of assets under management at the moment, and we hope to double that in the next 2 years. So It's very interesting. So basically, I have been heavily involved in direct investment, but I have never actually invested in the stock market. So I'm hoping to learn a lot about investing in the different valuation methods in order to find good companies at a fair price. So it's been very helpful so far to join you guys at the Value Investors Meetup. So obviously I don't have a great sort of knowledge of the different valuation methods. I'm aware that you can judge how well companies are performing using basic metrics such as annualized returns over a period of 1, 5 and 10 years. So it's very basic information that I'm presenting, but nonetheless I feel that these companies have, quite a lot of them have a unique selling point. They hold assets that are that I feel will perform very well long term. Some of them are owner operators as well. They operate companies within their assets that are also very profitable. With coronavirus implications, they're currently, I feel, very good value as well. Some of them have dropped 30–40% in the last month. So if you have any questions, please let me know. So we'll get straight into it. So basically, I've broken down. I've picked out 4 companies, be it listed real estate company or a REIT from the UK, and then as we move on, I've picked out 4 companies from the US, listed real estate companies and REITs. So basically, the UK companies that I've picked out are small and medium cap, and the US companies that I've picked out are medium and large cap. So the companies that I've picked out, we have Big Yellow Group, Segro, Unite Group, and Primary Health Properties. So Big Yellow Group is a company that I've been following for a while. I really like them. They're a FTSE 250 self-storage REIT, largest self-storage company in the United Kingdom, and they have approximately 95 sites across the UK. At present, they have 1.6 billion market cap, very small dividends, so don't worry about that. And annualized returns over the past 5 years are 12.7%, and over the past 10 years, 13.5%. So actually, one thing I must mention is that in order to give a fair or a fairish judgment of the annualized returns over the past 5 and 10 years, I actually started from say 5 or 10 years ago, but then cut off just before coronavirus sort of kicked in. So that gives a fairer assessment, really. So Big Yellow Group, really like the company. It's very affordable self-storage, so you may have the typical customer may be students that are working abroad for the summer or doing internships in a different city and just looking to keep some stuff in a small self-storage unit on the cheap. And I think it works out the most basic package they have, which would be a small sort of storage cabinet, maybe, I'm not sure, 5 foot high by 3 foot wide, maybe £30–40 per month. So it's very affordable, whether you're a student or a young professional, or you're a family moving home looking to temporarily store goods and belongings. I think it's very affordable for all its customers. The brand is very good as well, and it's well run. The management that are in place are very good as well. So I think this is a company that has performed very well in a previous recession. So I don't see that being any different with coronavirus. Whilst we hope that coronavirus is temporary, I feel that this company, if bought now, would realise very good value over the long term. So we can have a look at how it's performed historically. So I guess the main drop there would be 2009. and thereafter performing quite well, and has took a recent drop from approximately 1,200 to 930 more recently because of coronavirus. So I think there's very good value there. And we can look at the company over the past 6 months. So you can see there's a very sharp decline since coronavirus issues have come into place. And more recently, there's a bit of a sharp incline. So from approximately, just gauging what I can see there, from approximately maybe 650, 675 from the lowest point, and now it's back up to 930. So there's actually been quite a sharp incline, and that may be because of people moving back home suddenly before, you know, transport restrictions kicked in. So they're looking for places to temporarily store their belongings. So I think overall, if you're looking at a minimum 5-year hold, definitely consider Big Yellow Group. Fantastic business. And the beauty of holding an owner-operated company is if the company fails, they could reposition the assets. Fundamentally, they hold industrial real estate assets. So if the company, you know, which I don't see happening, if the company suddenly underperforms and goes bust, you know, they can sell the assets. The assets have realized value as well. So you have that to play off. On to Segro, which are an industrial REIT, FTSE 100 investor and developer, largest industrial property company in Europe, 8.5 billion market cap, and very small dividends. Annualized returns over the past 5 years, 16.4%, and annualized returns over the past 10 years, 10.74%. So it's quite interesting to see the growth over the past 5 years in comparison with the growth over the past 10 years. So that's obviously simply because e-commerce has grown substantially in the past 5 years. So it'll be interesting to see how that performs moving forward. But I think fundamentally, very good company. They hold very high quality assets, and they have a monopoly in the market. Not only can they purchase large sites and large assets, but the company moving forward will also look into purchasing portfolios or whole companies that own industrial real estate, so they have that advantage. Performance over the past 5 years, performed very well, good steady upturn, and over the more recently the past 6 months, sharp decline, which we can assume is because of coronavirus, but then a sharp upturn as well. So I would say, again, minimum 5-year hold. You wouldn't, in this current point in time, I wouldn't look at a company like that over the next few months. You'd be talking 5-10 years minimum. And Unite Group, so it's a FTSE 250 student accommodation REIT, houses approximately 50,000 students across 140 buildings in the UK, 2.9 billion market cap, 17.5% annualized returns over the past 5 years, and 16.6% annualized returns over the past 10 years. This company's been performing fantastic. Student accommodation propcos and REITs have really been, it's a very lucrative area of the sector. So I would definitely hold this, even to just diversify within maybe your property holdings, if you have any, or you're thinking about which companies to invest in. I mean, student accommodation, given that there won't be any implications because of Brexit, which I assume there won't be, you will always have countries all over the world that view the UK education system as, well, number one, affordable for some countries, and also very high quality and prestigious. which will allow them to either work in the UK upon graduating or returning to their home countries and finding a very good job because of it. So I don't think that's something that will change, and therefore the demand for international students and domestic students as well is always going to be very strong, in my opinion. So a quick look at the company. Trading about 800 per share at the moment. So there was a very sharp upturn from what looks like perhaps around 2007, 2008, up until more recently, just before coronavirus. So actually you've got that nice little discount there from about 1250 down to 800 in the past couple of months. So 6 month growth. Yeah, so we're at about 800 at the moment, and you can see just before coronavirus kicked in, you were at about 1300. So yeah, a significant discount there. Really good company. Primary Health Properties, very interesting company. So a bit of background about the company. Basically, there was a portfolio that was sold by the NHS to a property company, Primary Health Properties. And this portfolio consisted of a lot of buildings that required some asset management and were therefore sold at a discount. But nonetheless, the majority of the rental income is secured against the NHS. Which is, you know, government backed, so therefore it's very, very secure income. So I mean, the purchase of the portfolio is a very large portfolio. I'm not sure how many properties, but the majority of which are offices and medical use, was purchased at a discount. It was then a lot of the sites were redeveloped, or there was some asset management, which also turbocharged the returns. And the company has been performing very well. Not only that, but the income is the key here. The rental income is secured against the NHS on very long leases. So, you know, if Armageddon were to ensue, in theory, we should still have rental income on the properties here, which is very nice. So 1.8 billion market cap for Primary Health Properties. 11% annualized returns over the last 5 years, and 8.8% annualized returns over the past 10 years. Yep, so since inception, which is back in '96, quite some time ago, steady growth over the long term, as you can see, not a huge amount of volatility. And more recently, a very sharp upturn. So obviously you have that decline there because of coronavirus, and then the share price has shot up. I imagine this would probably be due to maybe re-gearing leases, or perhaps the company's being forced to purchase new properties in order to facilitate NHS requirements. I'm not quite sure, but it's quite interesting to see how that plays out. Okay, so sorry, let me just see if there is any questions so far.
I think one person had a question, but Kason, did you want to ask a question? All right, Chris, maybe you want to continue. Hello? Kason has asked. Oh, sorry, go on.
Hello? Can you hear me?
Yes, so sorry, you have a question?
Yes. I looked at PHP in the past, and I don't know whether the liabilities have improved, but they were very highly leveraged. So I don't know whether you looked at the liabilities.
Okay, I haven't looked into their leverage levels. Do you know approximately what kind of leverage they have?
That was a long time ago, but it was really an issue at the time.
Okay.
Never
yeah,
mind. It's just a point in passing.
Yeah, no, that's great. Thank you for raising that point. I mean, with property investment, I always assume that you can never really leverage past 80% loan to value. But I think if we're talking about high leverage as in 70% loan to value, then I don't think it's an issue here as such. I mean, the key for PHP is they have income secured against the NHS. So that it's highly safe. It's not secured against, let's say, a retail operator that focuses on high street retail. So I don't think there's anything to worry about. If it's leveraged from 70 to 80%, I think that makes sense because you have covenants in place, that very secure income. So therefore you turbocharge the returns by leveraging up that extra bit extra. And we have another question from Kaizen. What do I think will happen if these REITs breach their debt covenants, given that demand may drop off in the short term?
Precisely, yeah. That's exactly my point.
Okay. Yeah, given that's a fair point. Students, for example, students may not go back to university if unis remain shut. Well, that's interesting. I mean,
also, I'd like to add that there has been a trend of deglobalization. So if coronavirus continues, I think, especially the UK economy, a huge percentage of cash-rich students are overseas. You could be in a situation where their parents are not sending them to the UK because they're not sending them abroad.
Yeah, it's a very good point. That probably wouldn't be my area of expertise to think about, sort of the more macroeconomic issues, but I can certainly try and address them. I think number one, for REITs breaching their debt covenants or failing to keep up with debt liabilities, there's all. I mean, it wouldn't be the first instance that property company or REIT has failed to meet their debts, but I think there's always options in place, whether it be a revolving credit facility is quite common, where if companies have seen a temporary downturn in performance, such as coronavirus, that causes implications, then it's very different from, for example, if I take a mortgage out in an apartment and I can't pay the mortgage for several months, the bank would probably be likely to seize it, whereas it's in their best interest to facilitate a large investor that has a portfolio of 5 or 10 billion, because that's a trickier problem to solve. So I think there's always different innovative ways to fix temporary income reductions, if you call it that. Number one being a revolving credit facility where the banks would, instead of having staged payments or fixed payments monthly or quarterly or semi-annually, they would instead basically accept payments on an as and when basis. That it wouldn't be a permanent solution. It would be temporary until hopefully the economy is good again. So there's another question. So would you be able to refinance or sell an asset to come to a comfortable level? From Zuli, refinance or sell an asset to come to a comfortable level.
It's more of a comment. Is to say that they can refinance it with other banks or institution, or sell some asset to come to a comfortable level so that they can keep on going.
Yeah, absolutely. Yeah, that's another option. Sell assets. I mean, for a lot of these companies, they try and avoid selling assets because that's where they get their firepower from in terms of refinancing. But yeah, perhaps if they've had assets that have been underperforming for a long period of time, then they may look to just load them, sell them, and use that as sort of compensation to get back to a good level. Okay, any other questions so far? Oh, sorry. Demetrius, is the annualized return on the stock price change or equity? That is equity, I believe. Sorry, I literally used annualized return calculator online, so I believe that would be equity. Correct me if I'm wrong. Okay, so I'm going to move on to US companies that I really like. Actually, one doesn't hold real estate as such, it's more of a tech company, which is the CoStar Group, and then Brookfield Asset Management, which a few people may have heard of. It's the largest alternative asset manager in the world. Canadian company, they operate globally. Prologis, which is the largest industrial real estate company in the world, and Digital Realty Trust, which operate in a very interesting part of the market. They own and invest in data centers. Okay, so CoStar Group. I'm not sure if anybody has actually heard of CoStar, but basically they're a global provider of commercial real estate information and analytics. So they generate revenue through subscription fees. And because it's focused on commercial real estate specifically, as opposed to small apartments, they focus on assets, large assets, and their main customer would be real estate advisory firms such as CoStar, JLL, very high-performing businesses. They have been charging very high subscription fees. I know that firsthand. Market cap of about 20 billion US dollars, no dividend, which is great. I've actually met people from CoStar. I used this software almost on a daily basis for 2 years when I was in a consulting role. It is incredible, absolutely fantastic. I've met the people from CoStar. They recently done a job in the UK where they imported, I think it was about 50,000 or something like that, 50,000 land registry contracts into CoStar, which means that you have that information. It took a number of weeks and they had several hundred people from the company working on it. But it's just one of the methods that you use to, one, stay ahead of the competition and stay the most effective and best provider of commercial real estate information and analytics. 30.1% annualized returns over the past 5 years and 33.6% annualized returns over the past 10 years. Really fantastic company, and they focus on not paying a dividend in order to sort of keep that competitive edge. I would say, in my opinion, they're far ahead of all competitors. Nobody really can touch them in terms of the amount of data they have. So, for example, using this day to day, what I would use this for, several different functions. When I was I did rotations during my time as a surveyor, and in taxation, I would use CoStar to find comparable buildings and tax rates. And if we felt there was a neighbouring property that had a lower tax band than us, but it was a similar property, we could then go to the valuation office and justify why our business tax rates should be mitigated. And then in the investment team, I use CoStar on a daily basis, several times a day. If an investor comes to us, let's say, for example, it's Aberdeen Standard and they've started a new property fund focused on core plus London real estate investments, and they only want to investment offices. So they might come to us with requirements that they want to buy a core plus asset. So a sort of trophy office that has a little bit of asset management play involved. And they might say, Chris, we want to buy an office that's minimum £50 million lot size. We want minimum income stream of 5 years, and we want it let to high quality financial covenants. 10 years ago, it may have taken you a long time to find properties. You would have to go out and speak to agents. You'd have to do various assessments in order to make sure that the properties meet the right criteria. In CoStar, I could literally put together a presentation or a spreadsheet for an investor within 1 hour with a list of available properties that meet their specific criteria. So it's a fantastic tool, and actually it was very interesting. I love this so much, and I worked under a senior director when I was in the investment team, who has, throughout his career, he's transacted about £5 billion of commercial real estate in central London. And he was always a bit skeptical of this, as you could imagine, very old school guy, and preferred the more traditional methods. An investor actually asked us to have a look at Scotland to see if there were any hotels or offices. I think his requirements were like 5 to £25 million lot size. And funnily enough, I actually used CoStar and was able to find a lot more opportunities than a senior director in the team who has, contacts throughout the UK that he utilised. So really interesting company. I really like them. And I mean, the only competitors they have in the market, in the UK market, bear in mind CoStar are global now. They've covered the US markets, UK markets, and a lot of the developed markets around the world very well. They have, I think their biggest competitor is Rightmove, who are based, in the UK, and their Rightmove are very good at the residential side of things, but in terms of commercial, they're nowhere near CoStar, who at this point now, 20 billion market cap, are making huge strides, and they're very innovative in the ways that they stay ahead of the competition. So here's CoStar since what, 98. So you can see probably around 2012, 13, 14, the company really picks up, and people obviously see that it can greatly improve business by using such a tool. Here we have over the last 6 months, so down to about $530 per share from roughly about 700. So nice little discount there. And they work on a subscription basis as well. So let's assume let's assume that coronavirus continues for 12 months. Well, actually, they've got subscription fees locked in for 5 years at a time, 10 years at a time. So and their main customers are JLL, CoStar, and other big property advisory firms who are very profitable and high performing. So yeah, I think CoStar is a great company, really like it. And then we're on to Brookfield Asset Management. So for anybody that's not familiar with Brookfield Asset Management, they're the world's largest alternative asset manager, about $540 billion of assets under management across real estate, renewable power, infrastructure, and private equity. So obviously it says here that BAM, Brookfield Asset Management, have a market cap of 40 billion, and that's because the company is split up into several arms. They have Brookfield Asset Management, which is focused on the real estate and private equity. They also have Brookfield Property Partners, which focuses on sort of core property investments. They have another company set up for renewable power, and also infrastructure as well. So there's quite a few arms, but this is the largest arm. And yeah, it has a small dividend yield, 1.8%, annualized returns over the past 5 years at 14.2%, and annualized returns over the past 10 years of 18.3%. The CEO is really an amazing guy, Bruce Flatt, his name is, and funnily enough, a lot of people call him the Warren Buffett of real estate. You know, his sort of value investing approach holds for the long term. They take a real long-term view. They buy high quality offices predominantly in sort of cities like London, Toronto, Sydney, New York, and they hold for the long term. You know, they take a real long-term view. So really good company, and that's what they look like since inception. So really good growth in the past 10, 15 years. And also more recently, they have, yeah, their share price is down roughly about $44 from what looks like 70, 71, might be worth checking that. But yeah, nice discount, and they have some absolutely fantastic assets. They're the largest owner of office properties in the City of London. So it's, you know, they focus on properties that are let to high performing financial covenants. Really good company. Okay, so 3 of 4 is Prologis. So it's an S&P 500 industrial real estate company, largest industrial real estate owner in the world, and the majority of the rental income is secured against high quality covenants. Amazon, Sainsbury's, Tesco, DHL, FedEx, 52 billion market cap, 3.3% dividend yield, and you've got 17.8% annualized returns over the past 5 years, and 15.2% annualized returns over the past 10 years. Fantastic company. I mean, in terms of the real estate sector, industrial has been absolutely flying. Whilst it may be very low in value per square foot compared to, you know, offices or high street retail, the growth, both rental and capital value growth, has been phenomenal. So when you've got properties, very large properties like Prologis does, that are in excellent locations and highly developed countries, and they're let against covenants such as Amazon, Sainsbury's, Tesco, DHL, FedEx. It's a no-brainer really. I mean, you have companies, Sainsbury's, Tesco, they are focused, it's warehousing, so it's focused on delivery shopping only, which is a growing area. DHL, FedEx, Amazon, I don't think there's anything to worry about with those companies over the next 5, 10, 15, 20 years, in my opinion. So it's a very good company to invest in. And again, you know, if let's say the worst case scenario happens where all of their tenants, current tenants, go bust tomorrow, which is very highly unlikely, then you have an opportunity to re-let to other covenants that may use the space. You know, industrial is really in high demand at the moment. So that's what they look like. Quite interesting to see how they've grown from what looks like 08, 09. Yeah, I assume that depth there would be 09. Oh, sorry, does someone have a question? Okay, sorry. So yeah, fantastic growth, and I would say this is a long-term hold, you know, really good company. And due to coronavirus, you're seeing about maybe 20 or 25% discount over the last month or two, which is nice. And on to digital realty trusts. Really interesting area this is, because it's essentially digital realty trust. It's a REIT that specializes in carrier neutral data centers. Carrier neutral, from my understanding, I just read very quickly about it the other day. Correct me if I'm wrong, please. Basically means that you operate from a data center, but you can switch your carrier or sort of network provider as and when you like. You have that sort of freedom, which I think must be very appealing for tenants that would operate such properties. So data center facilities are, yeah, very interesting sector, which I would say is going to, yeah, it will be a great high growth sector over the next 20, 25 years, in my opinion. So the company, they're strategically located in very legally stable countries, and that's because of data protection laws, etc., which is very important for companies. So they have 225 data center facilities globally. They're the leading company in this market. 3.84% dividend yield, which is attractive. 12.8% annualized returns over the past 5 years, and 12.2% annualized returns over the past 10 years. Data centers themselves are very interesting. I mean, the security is fantastic. They're highly secure. They have all sorts of technology in place. There was one that I looked at before near Heathrow, and it had technology that was capable of extracting oxygen within a matter of seconds from a room, a full room, and that was to prevent fires from destroying any data. So it's really interesting, and I think it's a sector of the market that is bound for high growth over the long term. And again, I always like to assess companies like this in a worst case scenario. So I think the worst case scenario here would be that in the future, we might not need 20,000 square foot industrial properties to store data. We may be able to store it in much smaller space, so therefore the demand would go down. But again, these are industrial properties strategically located, so I think you would be able to get a second chance in terms of reletting or sort of repositioning the assets for another use. So you can see the company since inception around 2004 have performed well with relatively little volatility, especially around the 2009 period, which is interesting because you see a lot of companies take a large hit around 2009. They've bounced back fairly quickly. So I guess the demand is very strong for data regardless of how the economy is performing. And we have over the past 6 months, we've seen a bit of volatility. So I think it's a good time to buy this stock, actually. Quite a nice discount at the moment. So that basically concludes the presentation. Thank you very much for listening. And there is one question which we may be asking. I know that I certainly am. And that is, how do we know when we've hit the bottom of the market decline? Well, interestingly enough, I read Stephen Schwarzman's book recently, the CEO and founder of Blackstone. I recommend anybody to read it. It's fascinating, really good book. And this is his answer to the question. Invest when markets have recovered at least 10% from their lows. Asset values tend to increase as economies gain momentum. It's better to give up the first 10 to 15% of a market recovery to ensure that you're buying at the right time. Stephen Schwarzman. So there you go. Again, thank you very much for listening. If anybody has any questions, feel free to ask.
Thanks a lot, Chris. Yeah, any questions? It's a perfect timing, by the way, Chris.
Really? Oh, that's, wow, 1 minute past 8.
Yeah. All right, cool. So guys, thanks a lot for your time. So this webinar is recorded, and hopefully you'll have a link tomorrow with this. I will try and, Chris, are you okay to share these slides out as well?
Yeah, absolutely.
Yeah, okay. So we'll put this up on our cityfalcon.com/meetup website. And then, yeah, I hope to do these webinars every 2 or 3 weeks. depending on demand and depending on what's going on in the markets. Thanks a lot, guys. Have a lovely evening. Bye.
Thank you. Bye.